Yeah, the reason we guys connected today because we want to present a new opportunity, and we are teaming up with um, really strong record, number one, and great people, number two, the RSN Property Group. So we got Reed Gusens. Reed, please welcome to the webinar.
Thank you so much, Igor, for having me, and hello to everyone listening in. And pumped and excited to be partnering up with a Vista Fund and Igor and co. And yeah, looking to dive in and tell you more about the details of the deal and why we're pumped to be buying it.
Good. And just a brief story of introduction, right? So I was part of the mastermind, and then Reed. It's been a long time, and Reed was every Thursday. So we get connected and we ask a lot of different questions, and that's how we first time ever met. So we got connected. So and Reed lives close by, so we met for just a tea, right, and for coffee, talk. And he was a crucial part of my development for sure. So and then he saw my progress, and then we actually invested in the RSN Property Group back in 22 probably or so, Lennox, 23?
23.
23, yes. And then we are like walk through the progress, right? We visited the property multiple times. We talked, we just connected, and it's been like a great performance so far. And then we decided to bring that opportunity for people, for investors, right, as well on our end.
Yep.
And just a disclaimer, right? It's an investment. It's always an investment. There's risks, right, inherited into investments like that. Please read it through, and it's not guaranteed again. So read the disclaimer yourself, right? And what are we talking about today? Why are we here today, though? Yeah, there's a very exciting opportunity, and it's actually in Texas, right? Avalon Apartments. That's going to be the branded name once we take over. And yeah, it's a great thing. So because we want to start with the company first, with the intro of the track record, RSN Property Group has been investing in Texas in general, right, for a time. Like it's been a long time for that. And there's multiple exits. It's not just the buys, but it's exits. And again, so you probably want to judge the company by exits, not by buying, because a lot of people are buying a lot of things. But again, if you see some exits was a great performance, and if you look at the stats right now, there's average 23% IRR. And me as an investor, and if I can go into the project and people saying it's going to be 23%, it's like that's a rock solid, right? Reed, what do you think?
Oh, I hope so.
Yeah, if you can,
like it's in the world of investing, it's double-digit returns in a short period of time is what people want to see, right? So, and I think that to your point, the whole reason you invest with folks like myself and like Igor is that we're real, and two, we have a track record. This is not made up. This is not fake. Like I can show you the closing statements of all these properties, and investors are really, really happy. So you're going to potentially be partnering if you choose to invest in this deal in us as a collective, us, investor as well, and RSN, that we have a track record. We know what we're doing, and we've built out a strong performance over the past decade. So just really great to have an opportunity to speak to you all. And yeah, I think back to your original question, Igor, I think it's pretty good track record.
Thank you very much. So again, it's been, they bought the things, multiple assets, right? 2017, 18, 19, and they exited in a really good time. If you guys invested for a while, so 2021, 22 was like a go-to times to sell things, right? I'm not sure about buying, was like pretty more cautious, but on selling was like no brainer, right? It was a great price. We call next slide, we call generational buying opportunity. Why? So why would you say it's generational, and why right now? Because we get some things like, oh, there's election in front of us, so why we should invest in this and that. So yes, there is, but if you look at the numbers and statistics, the price for last, let's say this, for last year or two, it's been not easy market, right? It's been pretty tough and tight market in general for multifamily. We're talking about multifamily right now. So if you look at what's going on right now, I would say it was in the last 6 months, right? Maybe less than that, 3 months, right? There is a deals coming on the market, which just make sense. They do make sense. Finally, why? Because the pressure cooker start to squeeze the people from like, we're going to sit, we're going to wait, we're going to be like, banging on the future, right? They need to get out and refi. They need to get out and do something because they cannot service the debt. So we start to see a lot more deals right now, and the prices start to come down because the owners start to realize, so we just lose the money every single month, or we got to do something, right? And something that's refi or just sell it, right, at the loss. A lot of times what we see right now, if they are lucky enough, you saw it at the price, right? They bought it back in 2020, 2021. But sure enough, right, there's a lot of people who would wipe out the equity of the investors and they sell it at loss, though. That's what's happening. So that's what we call the generational buying opportunity. And no matter what the election is and who's going to be next president, the good asset is a good asset right now, right? What do you think, Rich, about that?
Yeah, no, I'll add to that. And part of what we as a group have done, like you might have heard a lot of people say pencils down, deals don't work. Well, that's all well and good for those folks, but we've continued to underwrite deals over the last 3-4 years, and we've been buying deals. Igor invested in one of our deals, the Lennox, right? When you're underwriting deals in real time, you get real time data. Like these graphs we're showing, once they've hit the graph, once they hit the news, it's kind of too late. And we just saw the Fed, as of this recording, has reduced interest rates by 50 basis points. We may have already seen the bottom in the last 6 months. I don't have a crystal ball. I'm not saying that's the case, but we're picking up this asset at a pre-negotiated price prior to the Fed dropping interest rates. So that's only going to help us. If the market if interest rates continue to drop and we picked it up at a fantastic basis, then that's only going to help us even more. So, it's all about timing in the market, but it's also about trying to keep your finger on the pulse in real time. And I think that's what you're trying to you get at here, Igor, is a generational buying opportunity. We have been trying to keep our finger on the pulse as best as possible and present it to people like yourself. So yeah, and don't take our word for it, as I said. I know where you're going with this, Igor.
Yeah. So thank you, Rick. And one more thing. So when you hear and when you see there's a institutional interest, and I think it tells a lot, right? Because those guys, they're not betting on like 1 year or 2 years. They're looking at the longer time frames, right? The more capital they deploy, they're not looking to sell that company they just acquire, right, for 3.5 billion. So they just looking for a generational meaning. So there's a longer term time frame when they're doing something. So if they buy right now, there's something in that market, in that segment where they buying, right? The Blackstone just got into that again, multifamily, right, and then some residential units as well. So for the people who is in the webinar, so you go to the Q&A section. Would love you to drop some questions. So we'd love to, to give you as much as possible information, right, and respond to all of your questions. Just a very quick value add multifamily investment. What is that thing? So, and Reed, I want to ask Reed a lot. So we've been sold on one thing, and I tell every single time when I go to the public speaking or something. So the real estate is a passive income. And you bought the first unit and you're like, okay, yes, it's passive. You bought the second unit. It's like, oh, you know what? It's probably like a quarter semi-passive. And then you bought 3, 4, 5. And all of a sudden you bought your new job, right? You got a new job, you self-manage those things. So that one is a little different, right? So you want to do a passive investment. So that's a syndication model. So that's what we actually doing, because if you own yourself, and again, a great example, he's operating the buildings, right? So how much percentage of the time you spend actually in operations, right? Because, a lot of people say, oh, it's a passive investment, I'll buy a house. What should I do? Go to syndication or buy a house?
Yeah, look, at the end of the day, the analogy I use, it's Inigo, I think this is a good one for your listeners and people joining, is like, think of a Boeing 747, right? Like we need to get from point A to point B, from New York, say, to LA. And if I or Igor were just to go hire that plane by ourselves, it would cost us a lot of money. But if we go and spread that cost across, the people and passengers on the plane, everyone wants to get from point A to point B. And in this case, it's, the passengers are the passive investors. They have money to go and put into commercial real estate. They may not have had access to these certain deals, but they want to still get on that flight. Well, in that same analogy, we've got the captain and co-pilot. That's myself, and Igor, and the first class team. That's the GP team. And we are driving the ship. We're steering the airplane, and everyone's back in coach, enjoying in-flight entertainment and putting their money to work and being part of a deal that maybe individually they couldn't buy because it's just too big. So it's the power of putting people's money together. It's the power of passive investing, and it's the power of investing in larger deals, which helps reduce risk.
Absolutely, yeah. Thank you. That's a great analogy, I think. And again, just very quick. So you invest, right? You get a quarterly cash flow, which is incredible. So I don't need to talk a lot about the power of the cash flow. That's one piece, and the second piece, you get the percentage share right at the end of the deal, which is very, very important. Why? Because that's the biggest chunk of money you're going to get for your investment. So, and what we found, the syndication will give you, I'm talking about the real estate, the multifamily. I'll stop on multifamily more, right? So it gives you both things, right? It's just proven model of getting both things. You get the cash flow, which is the power, right? And you get the appreciation on the back end, which is absolutely incredible, right? It's like a bonus, right, at the end of the day. So an investment approach here for us, we've done multiple different deals, right? And then there's different asset classes, right? There's different operators, right? And there's different locations as well. So what we found working, so the value add, which is not deep into the construction, was the most, I wouldn't say successful, but the safest place to be. And this is exactly what we're doing right now with the Dallas deal, right? That's a safe play. All right. There's nothing to like a ground up development. There's a piece of it and it's like an ace in the sleeve. But again, so we might use it, might not, but then there's no X factor on that thing. It's all proven model. So our Group was doing that for multiple times, right? Not 1, not 10. So it's multiple, like, I don't know how many, like more than 20 times probably, right, Reed? How many
we've done 25 syndications to date.
Yeah. So it's 25 times they've been doing this. So what are the chances we're going to fail on 26 ones? I mean, there are some, but it's just a minimal, right? That's minimal. That's what we want to bring to investors, like the minimal risk on on your investment, I would say, on your money. So Okay, and let's go further, right? So we're going to go into the intros real quick. So I'm not going to talk a lot about obviously the fund. It's me, Igor Shaltnau, right? We formed in 2020, and the first idea was we're going to bet our own money to really understand how the space works, and then we really understand what are the best operators, and out of that we just bring in the best out of the best, right, to you guys. And then so for now it's at 22 projects, and then we got about 5 really good partners we're working on a consistent basis, and it's 150 check average from the investor from us. So RSN Property Group, founded in April 2014, and it's a multi-family real estate investment firm owned by Australian investors, right? That's going to be very fun. And why I'm saying fun because a lot of Australian people, like when they see it, they're like, "Oh my goodness, we're from the same place." So it's a lot of connection there. So and why we actually focus on this type of assets and then RSN Group as well as a part of the partner, because they doing exactly what works. So they're not going deep into the construction. They're not finding those like over opportunistic models when they say, oh, we got to build another building for like a 400 units next to that, and now you're going into the weeds of the construction. They actually doing a really good model. So, and then we see that model working years and years. So, and with that being said, so they started in the Dallas market a long time ago. They know exactly what they're doing in Dallas. They know exactly what the insurance costs. They know what the taxes are. They got the great property management company as well. We'll talk about that a little bit later. And the target investment that produced for those years was above 17% IRR, which is great. And then it was usually between 3 to 7 years old, and between 1.7 to 2x multiple as well. So, which is, there's nothing more you can ask for, right, in those type of investments. If you can do that on consistent basis, and you just look at the team. Do you want to go through the team, Reed, a little bit?
Yeah. So, and again, my just a quick on my background. I moved to the United States in 2012. My background's in structural engineering. I've been involved for my entire career in ground up construction, real estate development. Started the company in 2014, and in that past decade, we've done 25 syndications, about 4,700 properties, and about $850 million of assets under management, transactions through the portfolio. I have my business partner, Ben. He happens to also be Australian, but uncoincidence, we both moved to the US chasing girls, and now they're our wives. We have Christian. He's American, and he's our chief investment officer. We have Mary, our fractional CFO. We have Patrice, heads of investor relations. Josh Oaten is our head of asset management, construction management. We have AJ, head of an analytical team, and then Willie also heads up, our account executive, and is responsible for fostering relationships with people like Igor's group and other folks we talk to and partner up with across all our deals.
Perfect. Yeah. Thank you, Reed. Thank you very much. And then just a little bit about the property, because again, you can do whatever you want to do, and you can come up with a brilliant business plan. If your property management company is not working, so most likely it's going to be a lot of troubles. Yeah, most likely. And then that's why, again, so it's not the first time. So it's been proven model was that property management. So can you tell us a little bit why it's this guys, and then why it's
So Strategic Property Management is a medium-sized firm. We prefer medium-sized firms, to be honest, Igor, and just to be on, to be very clear with all your investors, every market we go into, and we're across 5 different MSAs: Phoenix, Texas, Atlanta, Carolinas. We use local property management companies, and the reason we use them is because they are responsible for essentially building culture and putting the right bums and seats on the property. Right. The reason why we chose Strategic is that they have a long track record in Dallas specifically. Now we have done deals in San Antonio. We've got property managers down there. We didn't bring them up to Dallas because they're in San Antonio. So we really go out after the people who are experts in the local market. And their C-suite team is headed up by a lady named by Anne Marie, and she has successfully built out this company. They manage over 70 communities across 20 years of being in the business, and they're just very familiar. Like, for example, the regional manager who was on site with me during due diligence a couple of weeks back has repositioned a property just down the street from this asset. So, they're the types of things that are invaluable when you go and hire a property manager. It's the local people who have been in the business for a long period of time. And the funny thing is, when you do this for a longer period of time, most of the people in these property management companies know pretty much most of the properties in their MSAs, right? Oh, I know that deal. It used to be called so-and-so. So it very much bodes well to the track record of not just us as operators, but the property management team who we have hired. And as Igor said, like, you make money when you buy, you lose it pretty quickly through bad property management. So making sure we're partnering up with the correct group is really, really important. One thing I'll just add, Igor, it's a little bit different, but I know back to RSN, one of the things we do a little differently at RSN is that we also control our own supply chain. So we have been doing, given my background in structural engineering, we bulk supply a lot of our product when we renovate the units. So think of flooring, think of cabinets, think of lighting, think of plumbing, think of sinks, think of granite countertops, all that stuff that we renovate these units in bulk. We actually bring that in from Asia. It's a big discount to what we can get, say at Home Depot, and we actually warehouse all that stuff in Dallas, and we've been doing that for the better part of 9 years. So it's something that not a lot of sponsors talk about, but we have been doing it for such a long period of time. It's not rocket science. It's just buying in bulk and making sure you're getting economies of scale. But it goes to show that we think a little bit more strategically about trying to save investors money, trying to get a big return on investment. For every dollar we put into the property, we want a certain return back, and really grinding on material prices is where we see the best fit. So I'll end with that, and we can get into the property itself.
Oh yeah, perfect. Yeah, so let's go over, and then just a couple things. Once again, it's Texas, right? And in my opinion, again, there's a couple of things. One, when I hear Austin, and then when I hear Dallas, sometimes I feel like, oh my goodness, everybody's buying in Austin, everybody buying in Dallas. So, but in that case, it's just a submarket of that. So the market is great, and one thing is true: there's a lot of competition on a good market. There is true, but once you start to move out a little bit to the submarket, and you still benefit from the growth of a general MSA, right, of the target MSA. So that's incredible, right? But you got a little bit less of competition, so you can still get that beautiful asset, right? But benefit from the general area. So property overview, purchase price, 25 million. So there's 19 residential buildings, right, on the property. And it consists of 226 units. So the good thing, again, the larger the asset, there's a more meat on the bone. So you can just hire, you can fire, you can get the people. Why? Because there's a lot more NOI, right, coming in. So, so what do you think? Would you get something like 100 units minus REIT, or would you get something like 100 units plus and maybe 200 units? Which one is the better spot, though?
In general, the more units you have, the more efficiencies you have, right? So this is 226 units. This is a nice, it's on the larger side. So we can have for example, we can have full-time office staff. We can have full-time maintenance people who just focus on the maintenance for this asset. That's all they do, right? They only focus on leasing this property up, where on smaller size assets, say a 50-unit property, it may not warrant or may not make sense to have a full-time person there overseeing the day-to-day. So it's, the larger the unit quantity, the more staff. So we have, I think, 5 staff full-time on site at this asset, 3 people on what we call 3 in the office, and 2 on the exterior, dealing with maintenance requests and all that sort of stuff. So it has people not 24/7, but 9 to 5 every single day of the week there, taking care of the day in the day out of the needs of this asset.
And we got the first question from the listeners, so thank you. We'll get you a question a little bit later. Thank you, Scott. So next things, it's again, market overview in Dallas, Texas in general, right? I don't know if I need to advertise Dallas, Texas. It's just it's like, for me, it's like a size of the country again. So if you're talking about just the California itself, right? It's just could be sometimes the 5th economy of the world, right? But then, so if you're looking at the Dallas, Texas, right, it's one of the biggest city inside of the United States, right? So it speaks for itself, right? We got 8 million population, and what I always say, it's a registered population. It's probably more than that, right? Because we're looking at the statistics, and when I see that, it's insane. So it's a 20% growth over the last 10 years, and it's not even taken in consideration from 2020 to 2024. It's probably, and again, I'm making an assumption, that's another 20%, because a lot of people moved to Texas, right, from different regions, right? And then there's 278 new residents to MSA daily, and we're talking about Dallas right now. But you can imagine, so you get pushed over to the submarkets. So that's what I'm saying. So you benefit from the general market, right, from the general MSA area, and you get pushed over. So just imagine the 50% of those people, renters. So they're not buying things. So they cannot probably, I make an assumption, so you cannot afford to buy the place, right? They go for the rental. So half of those people out of 278, half of them will be like potential, right, people for living in an Avalon apartment complex. Number 1 fastest growing economy, all right? MSA in the US. That's huge. And then number 1 largest city in the USA. So again, that's a huge market. And you can tell by the professional teams. I play sports. I'm usually judged by how many professional teams do they have? And then how many sports? All of it. They got it all, right? That's it. So that means all the franchises, they know where to, open the new franchise. They know where to get to the next level. So, and this is the growth of the Dallas market, just the GDP of Dallas, right, itself. So we're going to go scroll over to, those are just statistics and numbers. And you guys can go deeper into those, right? We're not going to stop, right, going into the details. But again, I feel like there's nothing better than just the Texas right now, just because all the companies move there, because all the employers follow those companies, right? And the employment in there. So we just need more places to leave. So, and yeah, so going into the specific details, right, of the business plan. So there's a couple of really interesting and great points, I would say, why we should go into that deal. And number 1, the company who used to be the owner of that property. So, and maybe correct me if I'm wrong, they are a development company, right? They develop properties really well. And all of a sudden they decided to just leave that or just purchase that property and then manage them. So they were not, I would say they were not experienced maybe that much in the property management side, right? And the asset management side, but they were really good developers. And then all of a sudden, and when I hear that story, I was like, okay, that makes sense. And then the couple that together. So there's first thing they did, they changed the windows in the whole property. So I don't know, I never seen company taking over the asset and they changing the windows. So can you comment on that one, Reed? How often
Yeah,
do they
look,
change the
in
windows?
high level, just to your point, so this group is, and they still own the asset, right? We don't own it yet. So just to clarify
Yeah.
that they're still currently the owners. They are a group out of Utah, and they're historically been more of a development group. They find land around major MSAs. They get it entitled for 50, 60, 70 units. They go and then build that and then sell it on, right? They're not owner operators. So and I've heard of this company before. So when I heard that they were the owner, I was like, oh wow, that's interesting. You wouldn't put a developer and an operator. They're not the same thing. Particularly not on this is a 1980s vintage asset, right? As you dig a little deeper, you hear, hey, they spent $4.9 million on the property. Like, wow, that's a lot of money. And then you dig even a little deeper, and you're like, they've replaced all the windows, they've replaced all the roofs. You're like, geez, in 10 years that I've been doing this business, I've never seen a property where the value add business plan was to replace the windows. Now, I'll put my engineering hat on and sustainability hat on. I love the fact that they've replaced the windows because it means that this property can now last even longer, right? Like it was built in the 80s. It's starting to get to the end of its lifespan. They've come in and breathed a new, fresh life into the asset. New roofs, new windows, new stucco. They've renovated 73 of the units. That's all, like, that ticks the box for me because we don't have to deal with some of these big issues, right? They've already dealt with it. But on the other side of the coin is that they're being forced to sell. They're into this asset for well over their skis. They bought it at the wrong time. And so we are picking it up where there is, quote unquote, issues going on internally. So we know that this seller is selling multiple assets in the market right now. We don't know the full story, but we've got murmurs of certain things that they're being forced to sell. So not only are we getting all their renovation dollars for free because they've only bought this asset 2 years ago, and now they've put all this money into it. They thought that they were going to sell it for a bigger number than what we're picking it up for. So just hearing all that, plus they've got other assets in the market that they're selling. There's just sort of it's indications that something might be going on, right? We're not going to blatantly say anything, but for us as potential buyers, again, it goes back to like, what have they done? They spent a lot of bloody money on this thing. That's good. That's good for us. So it means that we don't have to spend that money on deferred maintenance, but there's a clear business plan there. And maybe, Igor, if you scroll back up, when I saw you put the rents in there. I think it was a little bit further up, but the rental rates of what they're currently achieving versus what we think we can achieve. So there we go, page here. So they've already come in and renovated 73 of the units. You can see it's highlighted there, and it's anything with the word reno, R-E-N-O. You can see it's bold and it's in bold, and they are already achieving $200 rental pops on average between the classic unit. So you look at an A1 classic versus a renovated A1. All we are planning to do is come in and do the exact same thing: renovate, increase that rent to match what they've already got. So they've already proven out in the business plan that this works. And so it's taking what they've already proven out and just continuing it, over the next couple of years, and then holding it for another for a 5-year hold. So very, very simple business plan. It's not speculative by any means because the proof's in the pudding. It's on their rent roll. Like they've renovated 73 units and they've achieved those types of rent. So I think that's really, really important.
Yeah. So yeah, what I just want to repeat it one more time. What Reed is saying. So when you go into the building, let's say it's a different building, right? Different plan. So, and now you're kind of speculating, right? If I start it's older building, right? There's no renovation to be done. If I start to renovate, I'm betting on the market, they're going to pay me like $250, right? More. But then it's all assumption. In this case, it's proven model. So here's the units. There's 73 of them. They already banking that, right? They're already paying that much. So there's no guesswork. Right? They already proven models. That's what Reed's saying is right now. So, and yeah, we got some comps as well, right? So we got rent comps for the unit. So I would say that's a ballpark, right? Plus minus. Again, there are some lower ones, but again, it's probably in the middle, right? Or maybe on the lower.
Yeah, it's in the middle. On the low end, you're about $100, and on the again on a one bedroom, and on a three bedroom, you're $260 below. That's just the market, right? That's the average for the market. So even if you don't look at their rent roll and see that they've already achieved some rental pops, just looking at what other people rent their assets for or rent the properties for, there's room to grow here. So that again points back to we're using data in the market plus the data that they've already given us in the fact that they're achieving certain rental premiums for a renovated product. So yeah.
So it's basically saying, so we're buying at the good basis, right? It's very important to get into the good basis though. And for the business plan, number one thing we learned 2021, 2022, when you get into the fixed rate and the project is working at this fixed rate, there's no X factor rate in the future. So you're not betting on the, oh, the economy will do really well. So, oh, the interest rate was going to go this or that. So it works already. You fix that. That's an example here. So it's going to be like a fixed debt financing with an agency loan. And it's going to be in the 5%, maybe lower than that. Let's see
Right.
how it's going to, yeah, I would probably say we can buy in rate. You're going to be buying in the rate. It's going to be more than, or less than 5%, which is just insane and just an incredible, right? So exit strategy, it's going to be 5 years hold, possible in 4, right? There's flexible financing on the year 4 so to get an exit. So conservative underwriting, we just talk about that. It's very, very important. So what is the basis first? So we're looking at the basis, number 1, and then from there we start that business plan. And there's a couple of things we want to talk about. The one is there's potential, there's a piece of land next to that, right? Which is, it does have an entitlement to build additional 26 units on the same property. So basically, if there is something in the future and you can get a JV or a partnership with somebody, so we can build those 26 units on that same property, it's going to increase the value again immediately by the end of the completion of the project. So that's one. And the second one, there's the possible development of tax abandonment, right? The upside on that is huge. I think, Reed, you were talking about like $400,000 could be saved on taxes. Again, it doesn't mean we're going to do that, right? Or so it's going to be the plan, but it's a possibility to do that. And
Yep.
I see a lot of operators, they do it in Texas. And for the ones who are successful with those things, why? Because again, if you look at the rent, it's pretty much on the lower end for the people, it's affordable things. You don't need to change the pricing. You don't need to go down on your pricing, right? You can just apply for that tax abandonment, right? And you keep those prices at the same level, right? And now you save on taxes like insane amount of money, right? Per year. Is that true?
Yeah, look, and just to be clear, guys, we have not underwritten these 2 aces up our sleeve, cherries on the top, the additional 26 units, the tax abatement. We have not underwritten the deal. We said, let's look at the deal standalone. Does it stand on its own 2 feet? And if we get these other 2 things, or just even one of the other 2 things, it adds additional juice to the deal. Again, making it very, very juicy overall. So they're up our sleeve. The numbers presented in this deck do not represent these additional things we could do. If we added these additional things, it would only make those numbers better. And so we're just presenting a very base case scenario, something that we can easily hit and easily achieve, but there is upside.
Yeah. So, and then once again, there's within the 5 miles, I just want to get some numbers, the key data, the parameters on that. So there's 192,000 people population within 5 miles. That means, yes, there is a demand, right, for the rental, right? And it's going to be a great opportunity for people to get into the beautiful space, renovated space. So there's 47% of the people. It's people who's renting. Again, it's very important because you look at some of the statistics, right, for some cities, and they are the owners, the property owners, they want to buy things, right? In that specific area, just 50% of the people who's renters. And then 190,000 average house price. That means, so it's questionable, can they afford to buy that? It was a $74,000 average household income was in 3 miles. So this is a good data as well. So the people will be pushed to the apartment living, right? And then renting as well. So unemployment rate at 3.4%, right? So those are the good numbers too, just overall. And sales comps, do you want to comment on that? Read on
yeah, like in sales comps, again, we're picking up at about 111K a door. We're picking up at an average discount to market. And you've got to, if you look at when these were sold, some of these were sold in the peak, which is okay. Like there hasn't been a lot of transactions. Like there's a recent transaction just down the street. It was for an older vintage asset, 10 years older, and it sold for $12,000 more a door. So, we're picking it up at a discount to those recent comps, but then to the market peaks, we spoke about earlier, Igor had that image up about the discounts that we're seeing today compared to 2008. If you just look at the numbers, what things traded for, DeSoto Ranch, 198K a door. Yes, it was a newer vintage asset, but you look at the 152 for Pleasant Creek Apartments. These are actual trades that happened at the peak. These are in the 150, 160, $140,000 a door, and we're picking this thing up for 111K a door. And it has all that work, that $4.9 million already baked in. Like we don't have to go and spend that again because it's already been baked in. So you have to understand that it's a truly baked number. So really, really fantastic basis. And then when again, going back to that slide earlier, this could be a generational buying opportunity, given that, we're starting to see the Fed shift gears and we're locking in a price for this asset. We already started negotiating this deal before the Fed started dropping rates. So I'm very, very excited.
Good. So there's, so I want to talk about a little bit about the investment highlights and the CapEx budget. So one of the questions is, and I got it from investor, right? So how are you able to fit into the $10,000 because it's $9,859, right?
Mm-hmm.
All of those improvements, because it does seem so lot.
Yeah, look, very good question, right? So there's different levels. So again, you have to understand that number is based on 226 units. But remember, 73 of those units have already been touched. So we're not touching them again. They've already been touched. They've already had the granite. They've already had the popcorn ceiling's been scraped off. They've already got new cabinets. So we're coming in and doing work to the remaining units. If you look at the price per door, price per unit, or $750, $1,300, it might seem low, but again, it goes back to scale of economies of scale. We are negotiating with our general contractor. He doesn't come in and do one unit at a time. Like, we will give him 4 or 5 units at a time per month. And he has a cadence that he knows he's going to get 3 to 6 to 7 units a month over the next 2 years. We can back into certain pricing. We can really, really grind on the labor cost. I also add in the fact that it looks like you might be missing the labor cost there on that slide, but we'll add it later. But add into the fact that I mentioned earlier, we bring in all our materials from Asia at discounted prices. We've locked those prices in, right? We don't have the general contractor beating us up or adding a fee on top of that. Adding a markup. So we're really just negotiating with them. So yes, we can get it done at such a cheaper price. And this is not like I put my finger in the air and I tested. With this particular general contractor, I've been working with him for over 9 years. I probably spent about $25 million just in renovation costs with him. So, again, a lot of experience in the Central Texas market, particularly with this GC.
Yeah, that's a great response. So I think a lot of things comes down to again, how much you buy it for, right? All those supply chains, right? Details. And again, if you buy it in bulk, you buy it well in advance, you're not constrained with there's time frame, I need to deliver that tomorrow, right? Blah, blah, blah. So you can get it cheap, right? That's the economies of scale. So you can scale those things. And not to forget, right? So REIT, RSN Property Group, they have multiple projects going on. It's not just the one thing. So there's multiple things. So they pre-purchase, right? A lot of things for multiple projects at the same time. So investment highlights, right? In that summary, initial funding. So it's a 15 million. And I think just to close it. So Reed, can you just say how much do we need just to close the deal?
To close the deal, we need like 9.3 or something like that.
Yeah. So, and it's 9.3 just to close the deal. And again, keep in mind, there's a lot of times there's a budget for the CapEx, but if they do change the roof, for example, right, you see how much less of the risk going into the CapEx, and it's in 19 buildings. So that's another huge benefit, right, of having that roof change, right? There's 19 different buildings. I'm sure there's one of them will be just going out of work, right? Because it's just so many of them. But then if they change all of it, there's a less of the risk, like getting the extra budget to some, things will pop up, right? And interest rate, it's very important. And it's a fixed to buy right now. So it could be below 5%. And then interest only 36 months, initial funding for 60 months. And prepayment, can you give us a little bit of like, what's the yield maintenance and how much is that? And then
so the yield maintenance is just because we're going with agency debt, it's a government-backed bond. And so they give us it at a certain interest rate, right? And if we break and we sign up for a certain period, typically 5 years. So we've got an agreement to pay this bond or this government-backed bond as a security. I'm getting really complicated, but I'm trying to break it down. And so if we break that contract in over 5 years, then they want to get paid their money. So the earliest we can start to break that contract, and as you get closer to that end date, so if we try to break the contract, for example, after 1 year, it costs us a lot more money than if we try to break the contract in year 4. As you get towards the end of your term, which is a 5-year term, we can then get out of the deal at a cheaper point. Come year 4, anything after year 4, we're good to get out, at a very minimal cost, so it doesn't affect the exit. But that's just that's the part of you might ask yourself, why are you doing that, Reed? Well, because we're fixing the interest rate. We have no risk of interest rates rising on us over the next 5 years, and we believe that's the best thing for investors to hedge the downside risk. Some might argue that we're coming into a lower interest rate environment. We get it, but we've just come through 2 years of going from 0 interest rates to 5.5. That doesn't seem like a lot, but the move was 500%, and that shocked the market, right? So we don't want to be caught with our pants down. We want to lock the rate. It's locked from day one. We don't have to worry about it ever again. We can sleep at night. So yeah.
So and then thank you very much. It's super super helpful, right? There's a couple things I want to talk about: equity stack and then investment returns. So there is multiple different classes, right? You can get it to class A. And what does that mean? It's going to be pref return, a little bit higher pref return. There's 10% and it's $50,000 minimum investment. So for the split, there's no split. So you do not participate on the upside. So it's going to be just a coupon clipping, right? Basically. And yes, you do get a tax benefit. And there's a 10%, like I said, preferred return on that. So there's a class B as well. That one will be participating in equity. And then there's a $50,000 in minimum investment. So there's a profit split 70-30. And there's, yes, tax benefits. You're going to get your K1s. And there's 7% pref return. And for the larger investment, so you got the 500,000. So it's a class C. And there's a little bit better of the split, right? It's 80-20 split, and the tax benefits are the same. You're going to get your K1s for investment, and preferred return will be like 8%. So I think those are the 3 asset classes. And yeah, I think that's pretty straightforward. Do you want to add something here?
Yeah, no, the Class A is there for those cash flow class. You can put a little bit in Class A, a little bit in Class B. And for those investors who are investing, larger chunks of money, you get you get better upside, right? You get an 80-20 split on the back end rather than a 70-30. So yeah, it's all pretty common sense. But if people have questions on that are a little bit overwhelmed by the different classes, then just reach out. More than happy to have a one-on-one call.
Perfect. Yeah. Thank you, Reed. And then we're not going to go deeper into the examples, right, of the returns. There's executive summary. So the purchase price, again, we're going to go over the numbers real quick. The high level, 25 million, whole period, 5 years, 226 units. So it's 90% occupied at the moment right now. So, and then there's a cap rate, again, according to the T12, it's going to be like 638, 6%. And it's a 1982 vintage. Which is, I wouldn't say it's too old, right? But it's on the older side for sure, but it's in a good shape. And it's consider all of those CapEx expenditures they spent, right? 4.9 million. I think it's a really, really good asset to get on. And the Q&A, there's, if you guys have any questions, please drop them in the Q&A section. And I'm going to go over real quick. So I'll stop on the last one right here. So, and I'm going to start with a question from Scott. Just a really quick. So the question was, would you purchase an asset in Utah?
Sure. Well, why not?
So just to be serious, are you focused on just some of the markets? So you like whatever the, whatever.
Oh, yeah. Okay. Yeah, so look, I probably didn't explain more. Like, I first cut my teeth in Texas, in San Antonio, actually, back in 2014. That's where my first deal was. Since then, I've done Austin, Phoenix, Atlanta, and South Carolinas. So we've gone across 5 different MSAs. The thing we have identified across the United States is that these types of B minus, B plus assets, workforce housing, they're very similar in terms of rent. Like, I can tell you, my deals in San Antonio, my deals in South Carolina, my deals in Phoenix, they're roughly renting for this. A 1-bedroom roughly rents for about $1,200. A 2-bedroom roughly rents for $1,500. Like, you start to see similarities. So the question to you is, you ask about Utah. Of course, I would entertain Utah, but I'm not an expert on Utah. When we look at markets, we go deep. We analyze many, many deals. Like, to get this deal under contract, we have already underwritten about 150 deals this year. We have bid on, oh gosh, probably 15, 20 deals this year, and we've only been awarded this one. So we go really deep into a market to understand, and we need to understand the cost of payroll. We need to understand, how much insurance is. We need to understand like what the cap rate is. So I haven't looked at Utah, but we could. But it's also just about bandwidth and trying to focus on markets that we think for the long term. And not saying that Utah's not, but we're really, really bullish on the Central Texas region. Like, it's continuing to grow. All the stats that Igor pulled up earlier, like, it's just a booming city, and we want to ride on those coattails. So yeah.
Sorry, I just got the full question right now. So it's would you look at 204 units, newer construction? Now, here's the kicker, though. 70% completed and fully occupied property in Utah, valued around 60 million.
Oh, it's hard to say. It's hard to say without looking at the P&L. There was a bit of, you said it was fully completed, but only 70% occupied or fully occupied. So look, that's yeah. Reach out to me on a different email. We can chat. I can give you my 2 cents. But the short answer is we're willing to look at things if they make sense. So yes.
Yeah, absolutely. Though. And then, next question, there's any way that project could be shorter? So for example, can we fit in 3 years instead of 5?
Yeah. Look, we have
what should happen? What should happen?
Yeah, look, we could, like, the answer is sure. But going back to, like, we are on the belief as operators that real estate is a medium to long-term investment. It's a wealth storage, it's wealth preservation. We fundamentally believe that. We have always pitched to our investors, we shoot to double people's money in 5 to 6 years. If we can do better than that, we will. And we have done better than that. But back to, like, the financing, like, if someone comes along to us in 3 years' time and offers us a really awesome money for this deal, and we got to break the loan and do all those things, and it costs us money to break the loan, but we're still making a lot of money, then of course we would sell. We're always a seller, right? That's when we make money as GPs. We don't make any money on this deal until we sell. So it behooves us to sell sooner, but you've got to also come in with the mindset that this could go 5 years. So, and that's normal. That's a normal term in real estate investment. Again, real estate is not a quick flip and, high octane type of thing. It's a slow and steady wins the race. And and the reason you invest in real estate is because you have all the depreciation benefits along with the cash flow and the appreciation. So it's just to come in with the mindset that, yes, it's a certainty. It's a possibility, but we're thinking we're going to go the distance at least to year 4. And if something crops up in between then, we'll let you know.
Yeah. That's a good response. So there's a couple more questions. We'll get a couple minutes, right? So
Yep.
up until 3:30. So there's the first one, because you mentioned there's financial distress, right? And
Mhm.
so can you give us a little bit of more details? What is that exactly happening?
Yeah, like I can give you the details that I know, right? It's the salesmanship of the broker, right? What I do know is there are multiple deals in the market that they're selling, multiple deals that are coming out of construction because they are builders, and they are selling those assets. From what I hear, it's the same investor who's in those assets that is in this asset. And then from what I'm also hearing is that it is the management, they're not being able to manage it properly. And we can see evidence of that by looking at their financials. We can see evidence of that by looking like literally touring the property and seeing, you know, the certain things like the staff and how they conduct themselves. You know, like a simple thing the other day, I called the property, left a message. It took them 2 days to call me back. Like it's just little things like that. So, you know, distress is what I'm being told. You know, do I know the exact story? You'll never know the exact story. No one wants to air their dirty laundry, but you can sort of put A plus B plus C gives you D. You know what I mean? So they've spent a lot of money. They bought it 2 years ago. They've got other assets in the market that are being sold. We've looked at those assets as well. You know, we're hearing it's the same equity, you know, on all those deals. You know, if it looks like a duck, it's probably a duck. You know what I mean? So yeah, that's you know, you'll never know the true goings on of anyone's private business, but you can sort of draw some conclusions.
Yeah. Got it. Thank you, Ray. That was great. Just the last question, probably before we go. What is the potential timeline, and what do you think? How many units? Because it says 70% of units will be renovated. So, what do you think?
So typically, our cadence is about 60 units a year. And now remember, there's a model that you've seen this. We've got to take a stance. It typically takes 2 years to get through a full property, but there are things happen, right? Like in the winter, for example, we won't renovate as aggressively as we will in the summer because there's different leasing seasons, right? So we will get into the property. There's what the model shows over a 2-year period, but we may do it in 18 months. We may do it in 30 months. Like we have the benefit of time, and we can also pivot as things change. We can ramp up quicker, or we can slow down if the market isn't there. But you know, at the end of the day, we're buying this with positive leverage. It cash flows from day one, so we could do literally nothing to the property. It's already cash flowing. So it's the cherries on top that that was, you know, we know, and again, we've done this across nearly 5,000 units across the country. We know how to, you know, play that out. We're not trying to kick people out either. We're trying to keep it highly occupied to keep the cash flow up. And as people move out, we then go in and we renovate and move on to the next one.
Oh, beautiful. Thank you. Yeah. I hope you guys got a lot of value from the webinar. And then I just want to say thank you very much, Reed, for joining and go on property. Yeah. So if you want to say something for the last part.
Yeah, look, just thanks again, guys. Don't be a stranger to reach out if you've got any questions for those newer folks on the call. You know, we're looking to create a long-term partnership with investor funds. So hopefully, if you don't decide to go into this one, you get the next one. But yeah, we're really pumped and excited to be welcoming this deal to our portfolio. And we'll, you know, again, don't be a stranger to reach out to either myself or Igor if you've got any questions.
Yeah. Thank you guys for joining, right? And Reed, thank you very much for, you know, bringing value and for your time.
Thank you.
We're going to conclude here, right? Thank you guys. Have a good one.